Equity futures is where the story is that we've been grappling with over the last week. That rotation, we have a little bit more fuel for it. The Nasdaq rolls over, the Russell, the small caps, rolls up. The S&P 500, a record high at the close on Friday, was set to add some weight to that as we count you down to the opening bout. Joining us now, I'm pleased to say, is Ben Laidler, Taylor Hudson Research CEO. Ben, the story really over the last week hasn't changed. It's the short-term risk, the long-term opportunity. Does the news this morning help us become just a little bit more tolerant of some of the negative stories we've heard across America over the weekend?
Absolutely. I mean, it gives you more visibility, I think, on where we're going. I think it accelerates this sort of rotation into cyclicals and maybe value that the market has sort of been trying to make, but has lacked the sort of courage to make that leap. And I think you're now absolutely getting that. We've had this sort of double catalyst of we're now through the election and we can sort of face forward into what I think is going to be a very big 2021 sort of growth rebound. And the vaccine, or the incremental vaccine news, I think we've got a lot more still to come here. Helps us sort of bridge that gap, if you like, over the sort of winter infection spike to a gradual sort of renormalization of activity and the way to play out these sort of cyclical stocks, which is where I think we're massively underestimating the sort of operating leverage.
Ben, you have been way out front on this. What we have is a distributed base with maybe some catharsis, of course, in March or April. What's your percentage up visibility out 12 months, out 24 months, out 36 months? How big is the Laidler leap?
Listen, I think it's huge. I mean, just to give you, so if you like the sort of tip of this, right, if I look at those sort of reopening stocks, the ones that have been sort of most impacted by this, even with all the rally over the last couple of weeks, I mean, they've still underperformed this sort of market darling sort of work from home stocks by over 80 percentage points. They're nearly 4 times price to book cheaper. They're not making any money. There's been where all the biggest surprises in third quarter earnings have come from on the sort of positive side, and revenues are still down between 30 to over 100%. So that's your sort of order of magnitude. I think this rotation has sort of barely, it's frankly barely getting started. And the other thing I would say is the other sort of fuel on this fire is investor positioning. And we've been saying for a while how cautious it's been. But just in the last week, you've seen it begin to turn and actually turn quite dramatically. And that, I think, is, the fuel that's going to come into the market here.
So, Ben, what on a day like today are you actually buying or doing? I mean, there is this feeling that long term it's going to be a good scenario. Short term, still a lot of volatility. Are you active on a day like today?
Listen, if your average investor is not carrying anything like as much risk, I think, as they should be right now. We're overweight small cap, we're overweight industrials, we're overweight real estate, consumer durables, and we're not overweight all cyclicals or even all value. I think this is much more a cyclical story, really, than a sort of value story. I'd make a small distinction there. But yes, I'd be focusing on where are you getting the most operating leverage to the sort of fear of the virus beginning to moderate over the next few months. And again, I think it's, in these small caps, industrials and real estate particularly.
And it takes you outside the United States, I imagine, as well, Ben. If you really want to get that high leverage play on the reopening and a vaccine, it's got to take you to Europe, which has been beaten up so badly. And it has that mechanical, that composition towards the names, the themes that you're talking about. Ben, can you walk me through your Europe call right now?
Europe and I would also say the sort of cyclical bit of emerging markets. So yes, so domestic cyclicals in Europe, for us, that's sort of financials. It's pretty much the cheapest, most hated, and one of the larger sort of sectors in Europe where, we're overweight there. But also within EM, right? I mean, everybody, including us, has been sort of hiding out in China and North Asia, first in, first out. But, the rest of EM is really your much more cyclical bit of EM, very similar to this sort of, U.S. reopening story, very depressed earnings and a lot of operating leverage. I guess the one caveat just on Europe is just watch the dollar and the flip side of that, the strength of the euro. A lot of these European corporates, sort of very, very global, very international. So, to the extent we get, too much of a euro move, that's definitely a headwind. But yes, broadly Europe, much cheaper, much more depressed earnings, and just seeing a lot more operating leverage here.